Hi guys, welcome to this Money Control live stream. You're watching Morning Trade with me, Nandita Khemka. It's a Friday morning, and of course we have that epic India-Pakistan contest in the ongoing World Cup tournament today. So of course all of us can't wait to get on with our weekends and watch that epic match. But of course we'll talk about that later. Let's first talk about all the global cues that we are getting this morning. Not very encouraging, but we'll have to see whether or not we remain resilient around that 19,800 mark or not. Lots of cues to digest today, including IT earnings and, on the technical front as well, a lot of stocks we'll be watching out for in today's session. But of course, you'll also be getting all your stock-related queries answered by our experts on the show. So if you have any queries, as usual, send them in to us on our YouTube feed and we will have them addressed by our expert. But before we do all that and before we bring on board our guests for today, let me take you through the top stories at this hour. Wall Street snaps 4-day winning streak amid hotter than expected inflation data. In fact, September CPI inflation rises 0.4% on the month ahead of expectation. Bond yields also rise as stocks come under pressure. Asian markets too open lower as higher than expected US inflation data soars SARS sentiment rather. The GIFT Nifty is hinting at a lower start for the Indian market. Crude prices reverses gains. In fact, Brent hovers around $86 per barrel mark as a sharp increase in US inventories offset expectations of tighter supply. Infosys beats estimates in the second quarter with a revenue growth of more than 2%, but ADRs, in fact listed on the NYSE, slump after the tech giant lowers the top end of its full-year revenue guidance from 3.5% to 2.5%. Meanwhile, HCL Tech revenue growth marginally misses estimates. Company lowers guidance even as margins beat expectations. September CPI cools off to a 3-month low of 5%. Food inflation eases to 6.5% as vegetable prices see a sharp drop. Meanwhile, IIP picks up pace with over 10% growth in August. However, the double-digit growth is largely due to a base effect. Well, let me bring on board our first guest for today. Then joining me is Siddhartha Khemka, who's the head retail research, broking and distribution at Motilal Oswal. Good morning, Siddhartha. Great to have you on the show. Before we talk about other stocks, I want to first get in your thoughts on, what Infosys has delivered. A strong set of numbers coming in, revenue front. It has beaten TCS and HCL Tech both. But of course, the dampener was the cut in the upper end of the guidance from 3.5% to 2.5%. Of course, it has not been digested very well by the ADRs. We saw 6.5% slump coming in. But of course, in today's session, do you think there'll be a slightly more focus on what they have done with guidance, or do you think the street will focus in on the strong set of numbers that they have delivered?
Very good morning, Nandita, and good morning to all the viewers. So if you look at what has happened even with TCS yesterday is that they reported a mixed set of numbers. So there is some disappointment in terms of the top line. But on the positive side, margins have seen recovery and ahead of expectations. And the best part has been, which is the strong deal wins. Now comparing TCS with Infosys, definitely Infosys reported a better, or you can say stronger revenue growth compared to TCS. And that is where the short term, you can say, impact will be more visible compared to a TCS versus an Infosys. Because while the large deal wins do ensure the long-term visibility for a strong earnings growth, but in the near term, the business flows remains tighter, and on a higher base, TCS is not able to manage that. Given that Q3, which is the December quarter, will again be kind of a weak quarter because of the higher number of holidays during this period and higher furloughs, so lower billing, it would be challenging for most of the IT companies to kind of give that strong growth again. So hence we have seen the cut in guidance from most of the large IT players, which what was also indicated in Accenture, which announced its results earlier. So I think market will be mixed in the sense, definitely, if you go by the guidance cut, I think market will be a bit negative today, especially on the IT stocks. The deal wins and the margins are more long-term and would only help improve the financials in FY25. So FY24, I think at least for one more quarter, IT stocks could remain under pressure.
Right, but looking at all the three companies that have reported last quarter, I think it was HCL that was the best poised, given the fact that in a challenging environment they had retained their guidance. But this time around, even they have cut their guidance pretty sharply. So, looking at all the three numbers now, which one of the companies are the best poised in terms of recovery? Of course, FY25 is being billed as as a year of recovery for some of these IT giants. So, which one of these do you think is the best poised now?
It's a difficult call given that all are placed on a similar platform, given that the key markets are facing the growth challenges, and that is where you are seeing discretionary spending cuts and impacting in the near term. Having said that, I think if you look at the business mix, HCL Tech with a higher exposure to the cloud, which compromises a larger share of the non-discretionary spending, given the way you can say the corporates or economies have moved towards digital and adapting that at a much faster pace. Cloud is something that is kind of now becoming non-discretionary. Hence, we believe that HCL Tech offers a better resilience in its portfolio in the current context, amid the higher demand for cloud, network security, and the digital workplace environment. Hence, given HCL Tech's capabilities in the IMS and digital space, we expect it to emerge stronger on back of healthy demand specifically in these segments. And hence, we believe that even on valuation front, this stock is trading at about 18-19 times FY25 EP, which is at a discount to something like an Infosys, and at a much larger discount to TCS, which always trades at a premium given its market leadership. We believe that the discount offers a margin of safety as well. So I think if someone is looking at these three companies, HCL Tech could be looked as a preferred player given its presence in cloud, networking, IMS, and better resilience in the current environment.
All right, HCL Tech, looking the best poised among the three tech majors. But let's shift focus to other sectors now. We can, of course, banks could expect some margin pressure in the coming quarter, in the present quarter rather. But given the fact that, they have, handed in a pretty solid performance in the first quarter as well. In the second quarter, would you still expect banks to hand in a solid report card? And could that be, could that in fact revive the kind of outperformance that we had seen, in the banking names last year?
So yeah, I think that is something which the street is factoring in. While the you can say the overall growth in the credit remains pretty strong, NIMS compression is something that we are all building in. On the credit front, we are expecting 14% credit growth for FY24, which is a healthy growth driven by continued traction, basically in the retail and SME segment. The corporate segment has seen some recovery, while the personal loans, real estate has seen a robust growth. Personal loans have been growing at about 31%, real estate about 39-40%. So those are the at least on the positive side. Now, in terms of overall expectations, we are expecting 22% earnings growth for our banking universe, and that would be driven by, as I said, despite the NIM compression, the strong business growth that would enable this to happen. HDFC Bank, again, there is some, you can say, because of the mergers, they have already announced some issues with regards to integration and shifting of the accounting standards, which lead to some issues or in terms of growth. But remaining that, if you look at the entire universe, we believe that a strong 22% earnings growth. Valuations have kind of remained under pressure because of the sector kind of underperformed. And I think now with the earnings recovery, some of these specific banks should start doing well after a long consolidation of 2 quarters.
Right. All right, that's the view on the banking pack. But going forward, as we get into the thick of the earnings season, Siddhartha, what are the other sectors that you're watching out for in terms of earnings visibility? Of course, Realty has given out fairly strong, quarterly updates. Autos, we have high expectations there as well. FMCG, not that much, given the fact that high inflation as well as uneven monsoon could bite. But, what would your favorite pick be, or what would be that one sector that you'll be watching out for?
Yeah, so if you look at the overall earnings season, while we are expecting Nifty earnings to grow at a strong 21%, obviously benefiting from a low base of 9% decline in Q2 of last year. But the bulk of the earnings growth will be driven by the banking sector, which is definitely has the highest wage. But apart from that, auto is another space which we believe should report a strong earnings recovery. We are expecting 87% earnings growth for our auto universe. And bulk of it will be driven by Tata Motors, where you are seeing strong margins recovery. Even if you exclude Tata Motors, the earnings for the remaining auto sector is likely to happen in the upwards of 30%, which is much higher than the overall base. So if you look at a demand wise, we are looking at strong demand from the passenger vehicle segment and the CV segment. Two-wheelers and tractors have seen some, you can say, contraction in demand, and that is where our focus has been in terms of the preferred stocks. Tata Motors, Ashok Leyland from the CV side, Maruti from the passenger vehicle side would be our preferred picks to play the result season in terms of auto, which are likely to report strong earnings led by demand. Softening of commodity prices has also led to margin expansion, which is also aiding the strong earnings growth that we are expecting for the auto sector.
All right, strong earnings expected from the auto sector. With that, Siddhartha, I'm afraid we are running out of time. I look forward to touching base with you as we go forward in the earnings season and discuss stocks and of course particularly the auto sector. Once the results come out, I'll definitely touch base with you on that. But thanks a lot for taking out time and joining in this morning.
Thank you so much.
With that, let me also bring on board our technical expert for today. Joining me is Raja Venkatraman of Neotrader. Good morning, Raja. Great to have you as always. This morning Q's not looking all that encouraging, but we have been resilient around that 19,800 mark, even though we ended just a shade below that level. But today setup not looking very positive. IT stocks, of course, could come under pressure as the street focuses on the guidance rather than the strong quarter that's been handed in by Infosys. What is your prognosis as to where the Nifty is headed today, and what are the kind of levels you'll be watching out for Infosys in particular?
Yeah, good morning, Nandita. So, and also to all the viewers. Now, when the fall happened yesterday, right, it was, I am just shifting the focus right now to the GIFT Nifty, and that's where the entire view is coming up ahead of the markets. So that's why I'm focusing the attention there first, because we were holding above 19,800 and we were all quite happy. But come evening, post the markets, the Infosys numbers really cracked down the ADRs, and that brought the GIFT Nifty down. But then if you see after the sharp fall which we saw in GIFT Nifty towards around 630, post that there has only been consolidation. And one of the main reasons has been that the fall has been largely triggered by the Infosys numbers rather than anything else. Now, if you also pay attention to the US markets, the Dow has been flat, the Nasdaq has been flat. So it is not that, there is a war triggered decline here. It is a stock triggered decline. So there is still, I feel that there is nothing much to worry about. We are going to continue to see stock specific action. And looking at the results of Infosys and TCS, yes, there is, it has definitely been on the, mildly anticipated, but then it has been beyond anticipation, and the reaction is going to come. There is going to be a reaction, and if you are holding IT stocks, then the news is not good. But then if you're holding some, if you're holding an index, yes, there is going to be a decline. But then I feel that around decline, one needs to wait for the first at least half an hour to see what is really going to happen. Because as far as I can see, there is going to be a sharp reaction. Nifty is going to make a bottom and then revive from lower levels, because we are having good set of macro numbers coming in, 14-month high, as all of us know, on the IIP. So inflation is cooling down to a 3-month low. So we are having positive macro factors building in, and stock specific result season is also going to emerge. So I don't see too much of decline on the cards. Now, as far as the OI data is concerned, Nifty as well as Bank Nifty had reached the break-even stage, right? It had gone to almost 1%. The PCR had gone to 1%. While Fin Nifty is even better. A lot of put writing is happening in Fin Nifty. So if you're looking to trade, then today Fin Nifty would be a good one, because at 19,900 there is a good base which has been formed. and crossing 20,200 would be a very strong move to the upside in Fin Nifty. So if you're trading on the indices, right, Nifty, and instead of Nifty and Bank Nifty, focus on Fin Nifty. That is my takeaway. Now, if you're looking to trade into today's market, like I mentioned, wait for the first 30 minutes, see what the index is doing. But then I will continue to exhort that stock specific action is going to emerge, and we are not going to see a sharp decline and a sharp breakdown as all of us are anticipating at the start of the day.
All right, that's the view then. But let me also shift focus and talk about some other stocks. Dr. Reddy's is one stock that is on my radar this morning. Stock hasn't really done all that well over the last 1 month or so. Raja, there is some news flow regarding this stock right now. US FDA, in fact, it has issued 9 observations for its Hyderabad manufacturing unit, and the inspection was conducted between October 4th to October 12th. The product specific pre-approval inspection has been concluded now. Dr. Reddy's hasn't really gone anywhere over the last 1 month or thereabouts. Would you advise investors to now wait it out for the earnings season and see how the earnings pan out and then take a position or take a call on where to or how to trade this stock going forward?
Yeah, so considering the growth in pharma, so many of the names have actually gone up. But then there are still some names like Cipla, Lupin, Dr. Reddy that have still not managed to generate some positive momentum. Now, as far as the recent news flows are concerned, if one needs to invest into the pharma space, I would continue to place my bet on Lupin. In the previous shows also, I have highlighted. Last week, I had recommended Lupin, and the trade has done quite well. And it continues to do well because it is receiving a lot of US FDA approvals. Now, when you focus the attention on Dr. Reddy, Dr. Reddy has been struggling over the last few days, and the momentum will continue to, avoid till it crosses 5,600. So, if you want to buy into Dr. Reddy, 5,600 would be the level. Till then, hold on and try to look at Lupin because it has got a potential towards 1225, currently trading at around 1180. So it's got a potential to 1225. Any dips in Lupin should be considered as a buy. So if you are a pharma, if you're looking to trade the pharma space, Lupin is number 1, Glenmark is number 2.
All right, Lupin and Glenmark looking attractive, at least from the pharma pack. But let's talk about, Ircon now. Of course, government has granted Navratna status to this company, and it will be the 15th Navratna amongst the CPSEs. If you look at the stock, of course, all of these railway stocks have, clocked in very strong gains on a YTD basis. But over the last month or so, this rally has fizzled out, and most of the stocks have given negative returns over the last month or thereabouts. This, kind of news flow, do you think that this could revive the kind of rally that we've seen in the earlier part of the year, or do you think it will just be a one-off and, we'll see some bit of a sentimental positive reaction coming in and then perhaps it will fizzle out?
Yeah, let me just highlight the nature of these kind of stocks. These kind of stocks have largely been news-driven rather than any kind of sentiment driven. So right now the news is fueling the sentiment, and there are no thematic influences which are emerging here. So these kind of news flows will not really push up the prices here. And as far as I can see, the overall, I witnessed some profit booking happening in Ircon. So if you're looking to buy Ircon, look to buy it around 120 levels. That would be my suggestion.
All right, those are the levels to watch out for on Ircon. But let's take up some of the viewer queries that are trickling in this morning. I want to start off with, Zomato. Of course, the stock has been on a tear. It has cleared that, triple digit mark quite comfortably. And now brokerages are coming out with positive reports. Some of them are, in fact, predicting levels of somewhere around 160. In fact, some of them even expect the stock to hit 200, in the medium term or thereabouts. But on the charts now, of course, there is a World Cup, ongoing World Cup tournament, and that wave is something that Zomato has been riding. So in the near term, what kind of levels would you be watching out for on a Zomato right now? And do you think it's too late to actually now enter into the stock?
Yeah, if you recall, last week we had discussed the World Cup has started, and Zomato is something which we should consider. And I had said that yes, this stock will definitely move up, considering the kind of possibilities. And now also with the way India is playing, I'm sure that Zomato's price is also going to go up. And currently, since our last discussion, it has already moved up by around 7 to 8%. And yes, there is room towards 120, and which could very much possible in by the end of the tournament.
All right, that's
So
the view.
look to buy at current levels and also on lower levels towards 105, 107.
All right, buy on dips should be the strategy on Zomato. But let's talk about a central bank. Sai Prasad wants to know your thoughts on this stock. Over the last 5 days hasn't done well, but in the last 1 month it has given a good 20% return. Do you think the dip that we are witnessing now is a good buying opportunity?
Yeah, right now the stock is undergoing some consolidation. Yes, the PSU banks are trying to rev up, but when you take a look at the entire bank Nifty as a whole, right, it's better to look at some pullbacks to buy into. And what I see that in central bank, a dip towards 44 levels would be a good level rather than buying it at current levels.
All right, a dip would be a good opportunity to buy here as well. But let's take up a query on, Tattva Chintan. This one is coming in from Divya. And she wants to know your thoughts on this stock. This stock has been stuck in a downtrend, since the start of the year. 30% kind of a downtick, on the charts. In fact, it is near about its 52-week lows as well. If somebody is holding, these shares, would you ask them to, in fact, average it out, or should they wait out for a, rebound to kick in sometime soon?
No, yeah. So ever since its listing, right, in way back in 2021, the stock has not really managed to generate a positive traction. So now, if you continue to hold this, probably you may see lower levels. It has broken a significant support around the 1650 mark. And if you're going to hold this, you're only going to see lower levels. So my advice would be exit your position and shift your focus to some other pharma name. That would be my suggestion.
All right, that's the view. Hope that answers your query. The next query is coming in on Polycab. Raja, Naveen wants to know your thoughts on this stock. Of course, on a YTD basis, stock has doubled. It's a well-tracked stock in the market. Now, how should one approach it? Given the fact that over the last 1 month or so, it has been fairly quiet. No fireworks, but on a YTD basis, as I mentioned, it's doubled already. So, what should the trade look like on this stock?
Right. So this stock is a leader in the wires and cable space, and the kind of movement which it has shown in the last 1 year has been quite phenomenal. Now, if you are looking to freshly invest into this stock, then this would not be a right time. You can use dip towards 4950 as a good opportunity to trade into partner into this, invest into this stock. If you are looking to trade, then continue to trade because the stock is in a bullish trajectory. So any day it is showing a positive momentum, one should trade. So as a trader, you can trade it at any level, but as an investor, look for a dip towards 4950 to participate.
All right, hope that answers your query. But before I move on to my next query, query on Gokul Das Exports, I want to get in a query on Anant Raj Industries as well. Debu K has a query on this stock. If somebody wants to enter into this stock at this juncture, would you advise them to do so? And what should the strategy be if somebody is already holding this stock in their portfolio?
Yeah, when you are seeing the tracking stocks like Anant Raj, they have not really been able to generate sufficient momentum earlier. But now over the last this entire year, it has been moving consistently well. And what I can see is that it has been able to defy the overall market situation and is on a steady trajectory upside. So continue to buy at the current levels. If you are already holding this stock, hold on to the stock, because the next target zone is emerging around 300 levels. So that could be a good target to track. So it's a good play. And if you're looking to freshly invest, the time is also right for you to freshly invest into the stock. So continue to do both. Either invest at current levels or hold on for higher levels towards 300.
All right. I hope that answers your query on this stock. But, this wraps up our query segment for today. But before I move on to your picks, Raja, I want to get in your thoughts on Gokul Das Exports. Given the fact that, Narayana Murthy-led venture has bought a stake in this stock, this of course comes as a booster, for the stock per se. But over the last 1 month, the stock is up 7.5%. Do you expect more upside on the charts now, perhaps towards 900 to 950 or thereabouts?
The stock has not really been able to generate enough momentum, but when you can see the backing of such a prominent name, so the probability of moving towards 1,200 is very much on the cards within the next 3 months. And one should look at this stock because this stock is showing some good momentum. There is a lot of participation at every dip. So I would look to buy it at current levels and also on dips towards 800.
1200 is the kind of upside potential that this stock has. But, Raja, before I let you go, what would you be recommending for our viewers this morning?
Yeah, so I would continue to retain my buy call and I would like to trade into Bharat Forge if it crosses 1125 with a stop loss below 1110 for a target towards 1145. And I would also look to buy into Titan with at around above 3300 with a stop below 3260 for an upside towards 3375.
Buy calls on Bharat Forge and Titan coming in from Raja. With that, Raja, thanks a lot for taking out time and joining in and addressing all of your queries as well. I wish you a happy weekend, and of course we have the most all-important match to watch out for tomorrow. Enjoy the match and we'll touch base next Friday. With that, we've come to the end of this edition of Morning Trade. From me and the entire team, thanks a lot for tuning in. But don't go anywhere because coming up next is Opening Bell.